Welcome to episode 57 of Contrarian Korner. I'm Ben Kellerin. Today we have a very special first-time guest on with us to talk with us about a bunch of different things from energy, passive investing, pod shops creating market distortions, and what's going on with gold to oil, some of these different things that I think are interesting. And he's one of the last energy bulls standing out there along with myself, but I think it'll be a interesting conversation. He's the author of the Felder Report and definitely has some interesting insights on what's going on in the market. So Jesse Felder, thanks for coming on.
Thanks for having me, Ben.
Yeah, so I figure we could start off with oil specifically, because that's one where I've been looking at it, and I think it's one of the most interesting setups for the next 6 to 18 months, but really kind of over the next 3 to 5 years, especially like longer term. And the narrative out there is just so bearish, where the consensus is basically saying Trump wants cheap oil, it's going to be cheap forever. And there's not much talk about CapEx cuts in the Permian and what's going on with some of these different things, where I think that's like the basically flashing red light kind of signifying where this is headed. But I'd be curious to get your thoughts on energy sector in general, and maybe some ideas on insider buying and some of the other stuff you're seeing there.
Yeah, just from a purely contrarian standpoint, I think one of the most interesting data points or anecdotal things that I've noticed recently is I think so many people, and pretty much anybody who spent any time around markets is familiar with the famous Warren Buffett quote: "Be greedy when others are fearful, and fearful when others are greedy." And everybody says, knows that that's really the key to Warren Buffett's success over the last 60 years. But when he, the last Woodstock for Capitalists, the Berkshire Hathaway shareholders meeting, he announced his retirement, and it was all over the media, right? Celebrating his career and his dramatic outperformance of the markets and these things. And a lot of, well-deserved praise for, what is probably the greatest career in the history of investing. The only negativity you saw about Buffett, and it was both featured in the Wall Street Journal and Bloomberg, was his position in Occidental Petroleum, calling it a mistake. And I just find it fabulously ironic that people understand you want to be greedy when others are fearful, but they don't see that that's what Buffett is doing in the energy space right now, right? By buying Oxy when everybody hates it. He's doing what he's done for his entire career, and that's made him, it's been the key to his success. So yeah, everybody hates energy, and it was on display recently, in the Wall Street Journal and in Bloomberg, saying, man, Greg Abel as his successor is just going to have this terrible Oxy position to deal with, and maybe he'll dump it, and I think maybe it's more likely they make an offer for the whole company. They have $350 billion in cash, and I think that would be more likely than them dumping the position. So I think Buffett is doing what he's always done. He's being greedy in the area of the market which is most fearful right now. And I think as a contrarian signal, that's the pretty valuable one.
Yeah, I was just about to ask that, because you look at kind of their stake in Oxy, like in particular, and you kind of game it out and say, okay, if they have all this cash, maybe it's the Warren Buffett kind of going out with a bang, like one last big acquisition. But I think it'll be interesting to see kind of how they move with some of these different ideas, because they basically, like you said, are sitting on a mountain of cash, and I'm not sure if there's other stuff they're waiting to buy, or if they're just kind of not seeing a bunch of opportunities, but they've been trimming a bunch of other holdings as well. So like everyone's saying, he's calling the top, he's retiring at the top, like all these different things. And it's like, he's like, what, 90 years old? Like he's not a spring chicken anymore. So I think that's probably a little bit part of it. But one of the things too, when you see someone's talk about gold and gold to oil, and you look at the, like, outside of oil going negative, which I think we can write off as a one-time financial market shenanigans, basically people getting off sides. But you look at those ratios, as like, even relative to other commodities, I think oil is extremely cheap here. But I don't know if there's anything you're looking for that timing to potentially start reversing because you don't need much change in that ratio. And I think gold's going higher over time too, but I don't think you need much change in that ratio for oil to basically wake up over the next 6 to 18 months.
Yeah, I think it's a good point. I think we're in a uh, commodities super cycle, right? The gold price bottomed in late 2015 and has been moving strongly higher for the last 10 years. I think, in fact, a lot of people don't know, but the gold performance the last 10 years is just as good as the S&P 500. They're essentially neck and neck. Um, Oil price went negative in 2020 and has been moving higher since. I think a lot of people don't understand either that since 2020, the energy sector has outperformed the S&P 500 over that 5-year period. It's given back some of that outperformance over the last 2-3 years, but the cumulative performance is still better than the S&P 500 over the last 5 years. And so, oil price went negative. And since then, I think we started an important longer term uptrend in the oil price and commodities generally. So I think if you believe we're in a longer term kind of secular bull market for commodities, a super cycle, whatever you want to call it, it's helpful to look at these ratios, I think, to determine, okay, what do I want to favor right now? And that oil to gold ratio or gold to oil ratio, however you want to look at it, is helpful, in looking at those. I think, when you saw oil, the ratio of oil to gold get very high in early 2022, that was a really good signal to kind of, okay, let's rotate out of energy and rotate more into gold and the miners. And that was a terrific buying opportunity in that space. Just as, it was a great opportunity in 2020 when the ratio got really low to start scaling out of your gold and mining positions and into energy. And so you look back over the history of this ratio, and right now, the only time the oil price has ever been this cheap relative to the gold price is at those 2020 lows. And so oil, you could argue, is really, really cheap relative to gold. It's got to be a great time, I think, to rotate out of your gold and mining positions. Not completely, right? I agree with you that I think we're in a longer term bull market. I want to keep a core position on, but if I'm going to overweight something, I want to be overweighting energy right now just because of that relative price, is very attractive. And I think in terms of, timing these things over the course of a cycle, you get good opportunities every few years to kind of overweight one relative to the other. And I think that's the clear message from that oil to gold ratio right now is it's time to be overweighting energy and underweighting relatively the precious metal space.
Do you have any thoughts on natural gas? Because it's pretty interesting to see the narrative from people that follow energy closely, where you have certain fund managers talking about we're shifting our exposure more to natural gas and certain equities in that sector. And it's when I kind of look at it, you see the consensus shifting to, okay, natural gas is going to be a good place to be because LNG demand and all these different kind of secular drivers that people talk about. I'm not disagreeing with that, but when it starts to become consensus, I do wonder if it's basically gotten to the point where everyone's getting on the wrong side of the boat at the exact wrong time. But I'd be curious to hear your thoughts if there's maybe any opportunities in natural gas or if there's certain things you like in that area.
Well, there's a couple of stocks in that area that I've followed fairly closely. Devon Energy is actually one that I've followed very closely for 25 plus years. When I met, in the late 90s, I met the then chairman of the company and started kind of following it closely because the hedge fund I was working at the time was, took a position in it, and there was a good amount of insider buying in the stock in the early 2000s, and it did phenomenally well through that bull market from 2000 to 2008, 9, 10-ish timeframe. And I sold the stock way too soon, but I followed it since then. And again, I think last year there was some insiders stepping in to buy stock. Comstock Resources is another one, but I've been kind of scaling out of that recently because it's done so well over the last 6 months or so. I think it's almost tripled in price. But that was one where, the largest shareholders, Jerry Jones, he's, obviously owner of the Dallas Cowboys. And last year he started buying heavily when the stock got down to, $7 or $8 a share or something. And I think it's closer to 20 now. But yeah, I mean, there are opportunities in these things. I think right now there's more opportunity in, the traditional energy space and the oil producers, and even some of the oil field services companies relative to natural gas. Like I said, Comstock has had an incredible run over the last few months, so I think that opportunity's passed. But yeah, I think natural gas, relatively speaking, is I mean, there's this huge arbitrage opportunity, right, where it's super cheap and abundant here, and overseas it's way expensive. And so the more we can, companies can find opportunities to arbitrage that by shipping liquid natural gas to Europe and China and whatnot, there's opportunity there. But that's not necessarily very easy thing to arbitrage away, right? It takes a lot of spending and debt to get those projects going. So, but I do think from the standpoint of natural gas too, that the increasing energy demand in the United States, right? A lot of people talk about nuclear. A lot of people are talking about increasing renewable production. The easiest, most efficient, the most rapid way to increase energy production is through natural gas fired energy plants. And so I think, to the extent that, these data centers are just creating massive demand for energy, it's likely to be met by natural gas production. But then again, I'm not super bullish on the AI theme. I don't believe that the CapEx right now is sustainable at anywhere near the growth rates people anticipate. So, that side of the demand story for natural gas might not pan out as well as people are expecting right now either.
Yeah. So you mentioned briefly kind of your view on a commodity super cycle. I think that a lot of people are expecting like a return to normal, and just looking at like what's happened in the last 10 years, kind of pre 2020 and all that stuff. But when I kind of look at longer term, like 10, 20, 30, 40 years, you kind of see all these things playing out over and over. And I look at bonds and long-term bonds as like good luck making money for anything more than a trade potentially. But one of the things I think is interesting is you have kind of a pattern where gold tends to lead kind of the broader commodities complex, and usually 1 to 2 years kind of head start. But one of the other things I find interesting is the number of people that are talking about gold and talking about the miners and talking about like, oh, energy's cheap. Like look at the margins they have. And if you kind of flip that on its head, like we were talking about gold to oil briefly, is the time to be piling into miners like when gold to oil is basically at all-time highs? Like I don't really see it. But do you have any thoughts on gold specifically and potentially some of the miners?
Yeah, I think, gold, like I said, I have a core position on. I don't have anything beyond that. I've been heavily into it really since that 2015-16 timeframe. But you can see, gold goes through, and my friend Tom McClellan has pointed out, I mean, the way that it trades is essentially the inverse of kind of the stock market, where stock market goes through these long kind of topping phases and takes a while to kind of roll over, and then has these kind of sharp V bottoms typically in risk assets. And you see the opposite in precious metals, where you get these spike tops and then kind of rounding bases in the gold price. And so if you look back, we had a spike top in after that 2015-16 low, we had a really strong move higher in 2016 that kind of petered, spiked and then petered out for a while, and took a little while to kind of consolidate. A big spike in 2020 that took a couple of years to kind of consolidate. I think we've seen another terrific spike in the gold price, and I think we're probably now starting a new kind of corrective phase. Part of what makes me say that is, you look at the sentiment in it, and we haven't seen a ton of, the amount of assets in the ETFs, the gold ETFs, hasn't really kept pace with the price. But when you look at the rate of buying on the ETFs, we recently hit a level that is kind of indicative of those kind of spike tops where people have been chasing the price a little bit too much, and too much money poured in too short of a period of time. And so there's that. And then if you look at the gold price relative to real interest rates also, which is usually one of the kind of main drivers of the gold price, you look at, when real interest rates are falling, it's very bullish, and when real interest rates are rising, it's typically bearish for the gold price. The real interest rate, essentially, like TIPS yields, have been flat for like the past year, which would suggest that the gold price strength is maybe a little bit overdone. If real interest rates have been flat for kind of a prolonged period of time, you expect more kind of flat trading from the gold price. So it might have kind of outrun its fundamentals in the short run. I think it might need to see continued strength, it might need real interest rates to come down. That's going to be difficult, I think, in this environment where people are, right? We had the debt downgrade for last week. There are no more AAA ratings for treasuries, and people are starting to question the embedded risk premium that should be involved in investing in treasuries, right? And so it's going to be difficult, I think, for those a risk premium to kind of disappear in the treasury market with the way that the potential tax cuts are going, the trajectory of the debt and deficits, these types of things. In fact, it could go the other way, right? We could see kind of a Liz Truss moment where interest rates really back up as treasury investors get worried about the lack of willingness to kind of do anything about the debt and deficits. That would potentially be a bearish catalyst for the gold price in the short run. Obviously longer term, if we see yield curve control, these types of things are, very bullish in the long term for gold. But in the short run, I think that the trends are kind of working against it in terms of real interest rates, the direction, and the over bullish sentiment that we've seen in the near term.
Yeah, interesting. The one thing I'll add maybe to the debt and deficits, and there's been like rumblings about tax cuts and what they're planning to do for people making less than 200,000. And I totally understand the argument that like what that does to deficits, but I think one of the things I think people miss, and some investors are too focused on the debt and deficit side, is what does that do to like the real economy, not just like markets and financial, like all the hyper financialization stuff that's gone on, where, right, if you have someone making 60,000 or 100,000, and then you basically overnight boost their real wages by 25%, just for round numbers, right? You're probably going to see that feed into inflation and feed into I would think, a much stronger economy, but it's also going to have inflationary side effects and other things. But do you have any thoughts on like what potential tax cuts might do as far as how that might play out?
Well, I think, the tax cuts right now, I think we're seeing right now why Scott Bessent said, they're not focused on the stock market, they're focused on long-term interest rates, because it is the bond market that will enable them to pass or not pass these tax cuts. I think that's what we're seeing right now, is they're trying to pass, tax cuts that would, potentially add $3 trillion to the debt over the next 10 years or so. And the bond market is saying, hey, we don't like the way this is going, right? You see the 30-year back over 5%, the 10-year back over 4.5%, and the 10-year looks like it could be heading to 5% itself. And that would be the message from the bond market that, look, this is not sustainable fiscal policy. You could get even a spike, like I said, in a type of a Liz Truss type moment where you see the 10-year yield spike over 5% and, basically threaten, it's interesting to me that so many people have been talking about the potential for a debt crisis. Bill Dudley, former head of the New York Fed, over the past year has mentioned many, many times the potential for, he uses the word turbulence in the treasury market in reaction to the fiscal situation. Paul Tudor Jones, Stan Druckenmiller has been warning about it for a long time. But I think even Buffett at the recent shareholders meeting came as close to using the words debt crisis as he ever would be comfortable getting. He talked about potential for runaway inflation, potential for exponentially growing debt. These are the types of things that are the definition of a debt crisis. So he basically was warning about a debt crisis without actually using the words. And I think it was in explaining why he owns 0 long-term treasuries, right? All of that $350 billion is invested at the shortest end of the yield curve in treasury bills. He wants 0 duration risk for this very reason. And that's a big departure from what he's normally done, which is in the past. I remember during the dot-com bubble, he built up a pretty big cash position, and he invested it mostly into 0 coupon bonds, essentially a huge bet on falling interest rates. He's doing the opposite today. So, I think there's this potential out there, and some very smart, people who manage a lot of money. Buffett owns 5% of the entire T-bill market right now. Have been warning about the potential for a backup in long-term yields. And, that's something that should be on investors' radar right now, because without any, willingness to even consider fiscal austerity at all, right, the trajectory of the debt and deficits is exponentially higher. That's a problem. That can't go on forever. And the longer that it goes, the more difficult, more painful it is to kind of bring it back in line. So Ray Dalio is another one who said, you have to get the fiscal deficit to 3% of GDP. That's the only way that it, can come back to anywhere near sustainable. The fact that we're 6-7% makes getting it to 3 pretty challenging. So yeah, I think in this environment, it's you have to be careful about the long end of the yield curve right now. I think there's still probably too many people bullish on bonds for the under the idea that a slowdown in the economy should be bullish and interest rates should come down. If it means that the deficit grows even wider because revenue falls and these types of things, interest rates might not come down. If Treasury supply is going to grow exponentially, you might have you might overwhelm demand for those bonds.
What's your view on the long-term path for interest rates, say from here until 2030 or 2035? Like, my view is that I think we're either headed for double-digit rates or some version of yield curve control, where it's like, okay, you don't just have a 40-year cycle for interest rates where it goes basically to 0 and then it's a 5-year like up wave. But I think a lot of people are just expecting that, like you said, recession, and you basically buy the long bond, and that's the hedge against it. But what's your view on the long-term kind of path for rates?
Yeah, I mean, I do think that downtrend in interest rates ended in 2020, and so we're in a new environment, right? It's something different than we've seen for 40 years, which is something that investors don't appreciate, right? So many people are just behaving in the markets right now as if that paradigm of the last 40 years is still in place. It's clearly not, and the interest rate environment is dramatically different. I do think we're probably in a new uptrend for rates, and if they were just markets were just left to their own devices, yeah, I think we would continue to just steadily march higher, kind of like we saw during the 1970s. I don't think that the government can afford that and can allow that to happen, right? I mean, that's the debt to GDP was a tiny fraction back then of what it was today. So it can't happen today without creating a debt crisis. So at some point, the Fed is going to be forced into yield curve control. But I think it's going to be, they're not going to be able to do that without creating an even bigger inflation problem, unless fiscal is also willing to kind of start to get its house in order. Right. I think the only way the Fed could engage in yield curve control inflation expectations are already, de-anchored, right? You look at University of Michigan, you even look at, Fed polls of inflation expectations now, and they're starting to rise in a way that it's really difficult to make the case that inflation expectations are still anchored. If you were to get yield curve control, there's no way inflation, expectations are going to remain well anchored as the Fed needs them to be. So, yeah, it's something that they can't do until there is really a debt crisis already underway. So, a lot of these things are just kind of timing questions. I think a lot of people are bullish on gold because they see these things down the road. But before you get to yield curve control and things that might be ultimately bullish for gold, you're going to have some serious turbulence in the Treasury market first. And it's going to probably force some form of austerity on the fiscal side that would enable the Fed to kind of do that without being totally worried about inflation expectations.
Do you have any view on how that might feed into different currencies? I know there's been, I don't know how many times I've heard like different podcasts talking about the end of U.S. exceptionalism. There's going to be capital flight going back to Europe, going back to other places around the world, and everyone's talking about end of the dollar and all these different things over the last couple months as we kind of had the tariff turbulence. But I'm kind of more partial to something closer to the dollar milkshake. But do you have any views on the currencies and how kind of you see that playing out?
Yeah, it's a good question. I'm not, the end of the dollar is may happen someday way down the road. But I think, right now it's still the world's reserve currency. And I think what people don't understand is you can get these major dollar bear markets without, the end of dollar dominance, right? You saw from 2002 to 2009, 10, 11 was a major dollar bear market, right? And that was the primary driver of the commodities bull market during that time. So dollar is at least as overvalued today as it was back in the early 2000s, late 90s. And that's, valuation, just kind of like it is in the equity market, is really the main driver of long-term returns in the dollar. You can just look at kind of a regression over, 10-year returns in the dollar versus its valuation. And the starting point tells you kind of the trend in the dollar over the coming decade. So you start a decade with a really cheap dollar like we did in 2010, 11. And that's a really good indicator that, dollar's going to have a bull market over the next 10 years. And that's exactly what we've seen. So, dollar bull market, you want to be focused on financial assets. Stocks and bonds are going to outperform commodities and real assets and these things. But in a dollar bear market, right? So we're starting now at the most overvalued point in the dollar in decades. That suggests that it's very likely that we'll have a dollar bear market over the coming 10 years. It's not the death of the dollar. It's just it could have a prolonged downtrend. And typically the major driver of the dollar is the trend in the deficit. So right now the deficit suggests the dollar is also extremely overvalued relative to the trend in the deficit. So if you believe as I do that the dollar is extremely overvalued, it's likely to revert to a mean and probably eventually become undervalued over the next 10 years. That dollar bear market means you really want to favor real assets over financial ones right now. And so, that's commodities, energy stocks, those types of things outperform. In fact, this is part of, to me, the really structural bull case for energy right now. It's about as bullish, I think, as you could imagine, because if you look at what's the primary driver of energy, the relative performance of the energy sector in the broad stock market, and it's two things. It's the trend in the dollar and it's capacity utilization. Essentially, what is the demand for kind of manufacturing and things in the country? Over the last 10 years, we've had this dollar bull market, and we've had kind of weak capacity utilization. In the wake of the great financial crisis, we've had this kind of weak manufacturing recovery. It's been perpetually weak, which has been, this kind of driver of the energy's underperformance the last 10 years. Strong dollar, weak recovery. If you think over the next 10 years, we're going to have a dollar bear market and this trend towards reshoring of production, renewing our infrastructure, deglobalization is going to be supportive of capacity utilization in the country. then that's the two primary forces for the energy outperformance, both kind of acting as tailwinds for the energy sector. And I think that's really what we're looking at in the years to come, is that we're going to see increased capacity utilization, because we need to renew the infrastructure of the country. We need to reshore production of a lot of these things that we've decided are of strategic national security. In addition to just renewing some of our economy from the ground up. So yeah, I think that bull case for energy built on a falling dollar and growing capacity utilization is something that I think a lot of people miss right now. And it's probably what people like Warren Buffett and Carlos Slim and Paul Singer are intensely focused on as part of the macro theme for their energy investments right now.
How do you view the, I guess, nuance between the dollar versus real stuff, right? Commodities, goods, food, and how do you view it as the dollar versus other currencies? Because I have basically a secular bearish view on Europe in general, and I think that's like close to 2/3 of like the DXY index. Do you have any thoughts on like the nuances there, or is it kind of there's going to be pretty much the same reaction to other currencies getting stronger versus the dollar, and the same is going to happen for commodities?
Well, I think, as part of that case of the dollar being overvalued, it means, all the other currencies are undervalued relative to it. It's mostly the Asian currencies. Yen is extremely undervalued. Chinese yuan is undervalued, but the euro is undervalued as well. And I'm just talking about like things like purchasing power parity. You can look at the Big Mac index. So my son was in the Air Force in Okinawa, and I went and met him in Tokyo, and we did kind of a tour of Tokyo, Osaka, and I was just blown away how cheap everything in Japan was. And I used kind of the Big Mac index to explain to him, how this works, right? The yen is super cheap. That's why, a Big Mac here is like $1 compared to whatever, $5 in the US right now. Translating the currency over. But that was the case in everything we spent on. And so, that's what I'm talking about in terms of the valuation of the dollar. So I do think that, part of these renegotiating of trade, not just a part, but a really, really big part of this, and the tariffs and things are aimed at revaluing the dollar versus these trading partners. I think it's very clear that the Trump administration believes that the undervaluation of the Asian currencies especially is an unfair trading advantage. And a big part of these negotiations is going to be, what are you going to do to allow your currency to appreciate? I think we've seen this with Taiwan recently, right? We saw the Taiwanese currency very, very strong recently, and threatened the insurance companies there that have been buying U.S. assets unhedged, for the currency. And it creates a real dilemma, for Taiwan. They kind of probably need to keep the currency weak to keep the insurance companies solvent, but they also may need to allow the currency to appreciate in order to try and get a trade deal done. And I think that's going to be a dilemma that's facing all of these major trading partners, right? I think Japan is probably one that's going to be interesting one to watch, because Japan's in a very similar situation where the currency is very, very undervalued. And as part of that negotiation, I think they're going to want them to allow the yen, to appreciate. But that's the case probably in every one of these negotiations. And so I think when you've seen this kind of in the past, with these major kind of multinational negotiations, where back in 1971, the Nixon shock, right? A big part of that, implementing 10% tariffs across the board, closing the gold window, was, hey, we need to make the dollar more competitive on the global stage, and and our goods, namely our goods manufacturing, more competitive on the global stage. We need to revalue the dollar. And they don't like to talk about revaluing the dollar lower. They want to talk about other guys raising the value of their currencies. And I think we're at that stage right now. And so I think that's a very clear message coming out of the administration. They're not kind of making that the primary focus of people's attention right now, because you don't want to come out and say we have a weak dollar policy, that could cause problems. But it's a very clear message that's really one of the primary objectives there. And so I think if you take that into consideration, that we want to make the currency more competitive to make our help with kind of rejuvenating our manufacturing economy. That like I said, feeds back into that energy case I was making a little while ago.
Does that feed into the potential view of other different commodity sectors? I've got a couple buddies that really are bulled up on certain things in agriculture and steel, and kind of go down the list. Like some of them really like silver and platinum. But are there any like specific commodities and companies that might benefit outside of energy that you think are appealing here?
Yeah, insider activity is one of the main things that I look at in terms of idea generation and kind of confirming my idea of where we are in the cycle and valuation. Are things cheap? Are they is the cycle probably turning for them? I'm constantly on the lookout for other areas of ideas. I really don't see much outside of the energy space right now. Another sector, though, that I look at is kind of like the fertilizer space. Mosaic and CF are a couple of companies that I've followed pretty closely. It's interesting. Mosaic is a company that the price performance has been for a long time really well correlated to the Chinese stock market and the Chinese economy. So, another I think big bull case for commodities generally, namely the energy sector, is the fact that the fiscal impulse from the U.S. has been really the primary driver of the global economy for the last however long, really, especially since COVID, right? Part of these negotiations is putting some of the onus on other countries to pay for their own defense, and really to kind of kickstart fiscal stimulus on their end to kind of help support the global economy and not put it all on the U.S. To the extent that Europe is going to kickstart fiscal stimulus and China is going to continue to ramp up fiscal, Japan may do the same. That's really bullish for demand of all kinds of commodities, right? And so I do think that that secular bull case is there, and it's largely going to be driven by this trend of major developed markets and China kind of implementing increasing fiscal stimulus as a part of to support this deglobalization, which would otherwise be pretty bearish for the global economy.
Yeah, before I shift over to some of the passive and other distortions going on, I guess, is there anything we didn't really hit on as far as commodities that you think would be worth wrapping up with before we shift?
Just the final point that I would make is, we talked about the ratio of oil to gold. Another one, you can look at the ratio of equity prices to gold or equities to commodities. And the equities to commodities ratio, or vice versa, look at commodities to equities, is about as cheap as it ever has been. So the fact that gold price has been rising for 10 years, energy prices up from 5 years ago, we're still, I think, in the very early innings of a commodities supercycle. Commodities are still extraordinarily cheap relative to financial assets, relative to stocks and bonds. And so from that standpoint, the value, relative value of commodities is really compelling. And if you believe, as I do, that these secular tailwinds of kind of a falling dollar and rising fiscal stimulus, rising reindustrialization, and these things are going to drive it, there's still a long way to go for commodities before you get anywhere near even middle innings, I think, of a commodities bull market.
So it sounds like you think we have a long way to go. Kind of what's your view on how long a potential commodity cycle might last?
They typically, like I don't know, these dollar bull and bear cycles typically run about 10 years. And so, 8 to 12, something like that. And so if the dollar is only now in the process of topping, it suggests that could be a process of, a 10-year process of the dollar going from overvalued to undervalued. And that's exactly what the valuation of the dollar today suggests, is that, you know, in 2035, we're going to be at a point where dollar is likely very undervalued relative to global trading partners. And that will be the point in time where we say, okay, wow, look at this 10-year run in commodities. And, you know, potentially a 10-year lost decade in the equity market might be a compelling opportunity to kind of rotate again out of real assets and commodities back into financial assets.
Yeah, I think we see a lot of similar trends going on. It's always funny to be so far out of step with the consensus, but I think that's what kind of creates opportunity in the first place. As far as the passive distortions and flows and pod shops and all these different dynamics that I like to call it the kind of trading sardine in a casino effect, where all these things are just tickers on a screen. There's no like fundamental analysis of a business, no actual looking at, okay, what is the business actually worth, right? The old school kind of value investing approach. Do you think that is another trend that starts to reverse and you start to see active management becoming a thing again as far as investments?
I do. I think right now that you know, there's an attitude among investors, and it's worrisome, right? I mean, in 2009 at the lows, right, and in 2012 around the lows of the real estate market, you saw the sentiment among investors was, I will never buy a house again as long as I live. That was kind of the way you knew that it was, and it's hard to imagine right now. But that was the sentiment in 2012. It's like, I will never buy, I'm going to rent for the rest of my life. This is incredibly painful, and it's not worth it to own real estate and go through this type of pain. Same thing in 2009 in the stock market. The attitude was, don't even talk to me about stocks. I'm just going to own, you know, treasury bills, CDs, whatever for the rest of my life. It's too painful. The attitude among investors is the exact opposite today, right? There's a couple articles last week celebrating the buy the dip impulse that has been just so strong. We've seen, you know, record inflows into leveraged ETFs. You have investors saying things like, you know, you have to buy every dip. Everybody knows you have to buy every dip because the market always comes back. Right?
MicroStrategy too.
Was that?
MicroStrategy too.
Yeah. I mean, it's not just you know. I think one of the quotes in this Bloomberg article was especially interesting to me. The guy said, you know, I got a little nervous in my triple levered QQQ, you know, when the market went down, but I just knew that I had, you know, the discipline to hold it. As long as I had the discipline to hold it through anything, I'd come out fine, and you know, hold it for the long term. I'm like, okay, well, triple QQQ is probably not designed for holding for the long term.
Yeah, it's
And
not exactly a coffee can holding.
yeah, and the history of the market is not that it always comes back, right? I mean, we've had, I think it's also instructive that we've had 2 lost decades over the last half century, right? From 72 to 82, lost stock market went nowhere. And in real terms was much worse than that because inflation was very high. From 2000 to 2012-ish, you know, we had another lost decade plus. And what are these, you know, what were the drivers of these, right? Well, in the 70s, you know, 72 to 82 was stagflation, right? Stagflation meant interest rates were trending higher and economic growth, unemployment was trending higher, economic growth was weak, real economic growth was weak. And that kind of drove demand away from equities, and the volatility in the underlying economy was made it difficult for earnings growth to grow in a sustained way. The last decade from 2000 to 2012 was the bursting of the dot-com bubble. Right, was really kind of the primary driver of valuations going from an extreme level to kind of a more reasonable level in 2011-12. I think we potentially have both of those catalysts for another lost decade today, right? We have stagflation. I think stagflation is here. We had negative real GDP growth in the first quarter, and inflation is poised to turn around strongly higher, I think, over the next few months. You look at any of the leading indicators of inflation. We talked about inflation expectations. University of Michigan, it's a pretty good leading indicator of the trend of inflation. Median inflation has only come down, median CPI at about 3.5% in the last few years, which is a really kind of, I think, better indicator of the underlying trend of inflation, right? Headline CPI is super volatile. Even core CPI, does not do a great job of, I think, showing the underlying trend. So 3.5% on median CPI and potentially turning higher right now. You have things like all the manufacturing surveys or prices paid indicators are surging higher. Empire Manufacturing last week, surging higher. These are usually good leading indicators of the trend of inflation. So inflation turning higher. At the same time, unemployment is probably going to continue to rise over the next year. We see home builders saying things are bad and getting worse, right? That's usually a good leading indicator for the cyclical components of unemployment. So we're in this stagflationary environment right now, which is typically really not good for assets, especially overvalued financial assets like the stock market is today. And I think we're also in the early innings of another bursting of a technology bubble, the AI bubble. I think that everybody's now written off DeepSeek as this thing that was, that was a false alarm. But really, when you listen to a company like Tencent had its earnings call last week, and they said, we have really abandoned this idea that the US tech companies are following, which is we need to continuously expand our data centers capacity and invest in more compute. Tencent said, why? Right? Why? DeepSeek showed that you don't need more compute. In fact, you can get way more efficient with fewer actual NVIDIA AI chips and these kinds of things, and you can get a lot more out of it than anybody believed. At the same time, you're seeing like OpenAI and Llama are pushing back the introduction of their new models because they're not getting the performance gains. They're spending hundreds of billions of dollars and they're really not getting any more performance out of these AI models. In fact, OpenAI's latest model hallucinates. It's 10 times more expensive than the previous one and hallucinates twice as much. So you're spending more money to get a worse product. That's not sustainable. And you listen to, somebody like Dan Niles, who says, we're probably in a digestion phase right now for AI. Cisco, the CEO of Cisco, said too that, these guys are going to keep spending. Just like during the subprime mortgage bubble in 2005, we're going to keep lending until the music stops. Well, it seems like the music is stopping here in terms of AI, right? There really are no products generating revenue to speak of to support the hundreds of billions of spending. So I believe we are seeing a bursting of a major asset bubble in the AI space. At the same time, we have a stagflationary outcome. These two things historically have been the drivers of lost decades in the stock market. So I don't think it's unreasonable to think that the performance over the next 10 years is going to be highly disappointing to the people who are all saying the stock market always comes back.
You mentioned real estate there briefly, and that's one where selfishly I'm hoping for a little bit of a correction. So I have a shot to buy a house. It's something that is not like 10 times income, but I think it's interesting to see how many people just kind of expect that it'll be like a pause or it's not going to come down much. But I'm kind of the view that real estate, especially in certain areas, is going to have a pretty rough road ahead of it over the next, call it 3 to 5 years if it takes longer than I kind of think. But what's your view on real estate?
I totally agree. I think right now we're starting to see signs of real weakness in the real estate market. I lived in Bend, Oregon for 20 years, and the real estate market there is really weakening. And I came to know essentially the largest real estate investor in the state towards the end of his career, and he was very insightful into how the real estate market in Oregon works, especially in places like Bend. Bend was, for people who don't know, it was the most overvalued real estate market in 2005 at the top of the housing bubble. And it was one of the reasons I started writing about markets and things to begin with, is I had just witnessed the dot-com bubble firsthand as the head trader of a hedge fund through the late 90s. 5 years later, I have a front row seat at the epicenter of the housing bubble. And it was extremely painful, that bursting of that bubble after 2005 to 2012, especially in Bend. And the fact that places like Bend are starting to see weakness It's much like, we say United States catches a cold in emerging markets, get pneumonia. It's very similar in real estate markets like Bend. That boom, incredibly. I mean, Bend was one of the strongest Zoom towns, right, during the real estate boom of 2020, 2022. As part of one of the reasons why I left, it became too overcrowded. But to the extent that things are slowing now, it first appears in these areas that boomed bigger than anywhere else, and I think that's really what we're seeing in these types of areas where the slowdown is starting to hit. Prolonged elevated interest rates are starting to hit, and really what happens in these areas is, you see the push to return to the office, right? You have all these companies say, get back to the office, or you're going to lose your job. So all the people that said, well, I can move to Bend and work remotely are now in trouble, right? And they say, okay, well, I'm going to lose my job if I don't move back to San Francisco or Seattle or wherever I came from. And if I lose my job in a place like Bend, good luck. I'm going to work as, operating ski lift, or, there's not much opportunity to make up that loss of income. So you end up seeing a lot of people do leave. And it's been interesting. One of the indicators I've looked at, is you could just look at the price of a U-Haul trailer from Bend to Seattle, or vice versa, San Francisco to Bend. And it'll tell you, like when it's $1,000 one way and $100 going the other way, that there are a lot of people leaving town, and that's not good for a real estate market. So yeah, I think that's where we're headed, right? You look at the number of unsold new homes in the market right now, and it's almost as high as it was at the peak of the housing bubble. That's not good for home builders, especially at a time when they're offering more and more incentives and still can't move houses. I think, we're going to see a significant weakening in the next, over this summer's, right, the big selling season. And it looks like it's starting off really weak, which is not a good sign. If you start seeing these guys lay off, workers who are building these houses, it could have ramifications for the broader economy and housing prices too.
Do you see that kind of taking a year, 2 years, 3 years, or do you think it happens, starts to happen pretty quickly here, where it kind of snowballs? Because I've heard people talking about, there's Airbnbs and all this other stuff that'll feed into it. I'm kind of wondering if it'll be maybe a little bit quicker than people expect, because people always say, real estate moves so slow, it takes time and all these things. I'm kind of I don't have a strong opinion either way, but do you have any thoughts on if it's going to take 3 years to play out, or if it's a little bit quicker?
Yeah, I think it does. It does usually take a little bit longer, right? I mean, people have an idea that it takes time for people, because the real estate market doesn't trade like the stock market. You can watch CNBC and see prices kind of flicker in whatever direction. It takes time for people to say, hey, wait, my house, my neighbor's house sold for X last year. My house should be worth X today. No, it takes a number of sales and, for more distressed sales in the market, for people to wrap their head around the fact that prices are falling. So, as I said, stock market bottomed in 2009, but real estate really didn't bottom until about 2012. And that's really when we started seeing the terrific deals in real estate in that Bend market, where, banks were basically just offloading properties. You make them a cash offer and they'll basically take almost any price. I mean, things were selling literally for 50, 60% below what they'd sold for just a few years earlier. And that takes time to play out. And so I do think, you'll start, I think we're already starting to see it in prices. You're starting to see price cuts in a lot of areas. But I think, you won't see a terrific buying opportunity in real estate probably for another 2-3 years.
Interesting. I'll have to keep that in mind when I start looking for a house. But I do have to ask you, as we're starting to wrap up here, I do have to ask you my traditional closing question, which is, what book should I add to my reading list? Can be history, finance, anything you think would be interesting.
I'm kind of looking at my screen here, what's behind me. I just had my friend, Peter Atwater, that's his book right there, The Confidence Map. I just had him on my podcast. He's a brilliant thinker, and that his framework is very simple, but it has terrific utility, especially for contrarians, right? I mean, I love the name of your show. If you're looking to be contrarian, understanding how confidence works in individuals, how confidence works in organizations, how confidence works in markets can be very, very valuable. And so I do think Peter's book is helpful from that standpoint. For me, I found it not just helpful from an investing standpoint, but just from a personal standpoint. We all go through times where we feel, super overconfident, indestructible, right? And then we all know that, right? Hubris is a, potential sign of, that you're going to make poor decisions. But at the same time, there's his framework points out that there are periods we go through where we all feel underconfident, and it's probably we have less confidence than we should have, and that's a valuable construct too, to understand that when I'm feeling like a terrible investor, I'm also going to be probably I might be missing out on opportunities that I might be more willing to take advantage of. And so just kind of having an awareness of how those things work is really helpful. And so Peter's book, I got to highly recommend that.
Yeah, I was actually listening to that podcast this morning. It's definitely worth a listen, maybe after listeners get done with this one. But as far as where my listeners can find you, where should I look for your work as far as social media or anywhere else?
Yeah, my website is thefelderreport.com. I put out a weekly blog post that basically just highlights a lot of the things that I'm reading, charts, articles, and stuff that I find especially valuable. I kind of just highlight the 5 things of the past week that I found most valuable. And so that's just right there. You can sign up for it on the homepage of my website. I'm also on X, but I've been more active on Blue Sky. I think both are just at Jesse Felder. So you can find me there.
Yeah, definitely go check his work out. I definitely enjoy the emails and all the stuff that I get from his website. But I think I really, really appreciate you taking the time to come on today. But I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.